What are the basic rules and records in accounting? Basic concepts in accounting. So here first what we'll do is we'll see what is a balance sheet equation, which is capital plus liabilities is equal to assets. We will first go through that, and then we will take a look at documentary evidence of cash transactions. We will see what is vouchers, and we will explain briefly on that. And afterwards, we will see what is debit and credit. So first, we'll take a look at what is balance sheet equation. Capital plus liabilities is equal to assets. At a given point in time, the claims of persons who have financed resources should equal the resources that may belong to that business entity. Also, it is worth noting the fact that the resources of a business unit are usually provided by its proprietors or outside persons, where the claim of proprietors are termed as capital and the claim of outside persons are called as liabilities. So for the assets which are sourced by the proprietors is actually capital, and if it is outside persons, it becomes a liability. Hence, the total assets of a business entity should always equal to its capital plus its liabilities, which is represented by this equation: capital plus liabilities is equal to assets. Next, we'll take a look at what is the documentary evidence of cash transactions, which is vouchers. So it is interesting to note the fact that transactions, especially financial transactions, are written in vouchers, which is a documentary evidence in support of documentary evidence, and hence may be a cash memo, which may be an example of a voucher showing a cash sale, or an invoice showing sale of goods on credit, etc. So remember that these transactions or its documentary evidence is supposed to be kept intact or preserved until such time a tax assessment is complete or an audit of an account is complete in the concerned time period in which they are used for such a purpose. Hence, one may write which accounts are debited. It is deducted in a sense, and which accounts are credited, which is deposited in a sense, which is usually done in a journal. Next, we will take a look at what is debit and credit. So the vouchers, the concept is actually simple. It may be a cash memo, it may be an invoice that are examples of documentary evidence of cash transactions, which we record it in vouchers. Next, we'll take a look at what is debit and credit. A debit denotes for persons when he becomes liable for something in favor of the firm, sees his account debited, or has performed that favor in favor of a firm. In the case of goods or properties, it indicates stock of value of properties and goods increase. And in case of other accounts, the firm has lost money for paying salary or rent is what is indicated by the term debit. So it might be something a person does in favor of a firm, or if it is in the case of stock of value of properties and goods, if it increases, it is a debit. And in case of other accounts, if the firm has lost money for paying salary or rent, it becomes debit. Now, what is credit? A credit, on the other hand, denotes, in the case of persons, a person claiming a return from the firm. If the person is benefited, if he claims a return from the firm, it becomes credit. If there are benefits received from him, in the case of goods or services, the stock and value of goods diminished. So in the case of goods or services, if the stock and value of goods diminished, becomes credit. And in case of other accounts, the firm has made a gain in way of commissions, it becomes credit. So that is basically debit and credit. So we have defined what is balance sheet equation, what is vouchers or documentary evidence of cash transactions, and we have also defined what is debit and credit. Next, we'll take a look at the fundamental books of accounts. So in accounting, there are a lot of books of accounts which we actually keep. And what are the fundamental books or the basic books of accounts which one keeps as part of accounting is what is dealt in this section. So even before we get into the fundamental books, there should be some understanding each one has about supplier, firm, and customer. These are very basic concepts actually. So to understand and have some background on the basics, one should understand the difference between production firm and manufacturing firm. So wherever goods are produced, that is a production firm. If it is done on a larger scale, it becomes a manufacturing firm. Now, for goods being produced, we need actually raw materials. So who supplies raw materials to the manufacturing firm or production firm? It is supplied by the supplier. So that is the concept of supplier. Supplier supplies raw materials to the firm. And when the goods are produced, where does the goods go? What does the firm do with the goods? It is sold to a customer. So customer is the one who buys goods from the firm. So we actually have a definition for customer. Customer buys goods from a firm. Firm produces goods. And in that process, it uses raw materials which they get it from the supplier. So that is the fundamental concept of that. Now, so after getting an understanding of supplier, firm, and customer, we will take a look at the different books, fundamental books of accounts. Okay. So we will see what is a cash book. Now, a cash book records all the cash transactions on the left-hand side or the left folio, which is a record of receipts of cash. And on the right-hand side or the right folio of the cash book, it records payments of cash. So on the left-hand side, it records receipts of cash. Right-hand side, it's payment of cash. In modern business, transactions through banks are also on the increase, so that it is incorporated also in the cash book. Hence, fundamentally in the cash book, there are two columns on each side of the cash book, one to record cash transactions and one to record bank transactions. That is, payments to the bank are entered on the left-hand side and payments out of the bank are entered in the right-hand side. So a cash book looks something like this, okay? Now, next is purchases book. What is a purchases book and sales book? So goods, all credit purchases and credit sales are recorded in the purchases and sales book. Whatever purchases and sales made on credit is recorded in the purchases book and sales book. And now what is returns book? Goods returned to suppliers are recorded in the return outwards since raw materials are involved. And goods returned by the customer are recorded in the returns inward book. So that is the returns book. Okay. Next, we'll take a look at what is journal and ledger. So when a business starts books for a new year, it has to make opening entry in the journal, which is the opening balance of various accounts that are to be transferred from the last or previous year. Hence, opening entries are made in the journal and closing entries at the end of the trading period are also made to close the books. Hence, journal, cash book, purchases book, sales and returns book, which facilitates the preparation of accounts of the ledger, are called subsidiary books. So journal, cash book, purchases book, sales book and returns book are called subsidiary books or book of original entry. On the other hand, the books that contain the different accounts is known as ledger. So that is ledger. Ledger is principal book, okay? And this is the final assessment of a financial position of a business emerges from these ledger accounts. Ledger is also known as principal's book and examples are computer account or furniture account. So there are two types of book. One is journal or subsidiary books and the other one is ledger. All the first entries are made in journal and it gets posted to the ledger. So that is what we actually see here, posting ledger accounts from subsidiary books. And there are also rules for ledger accounts while posting. So we'll get into that right now. So there also exist rules for posting to ledger accounts from subsidiary books. As for instance, the opening entries are first posted, then cash book is posted, Then purchases, sales and returns books are posted, and finally the journal is posted. Posting other entries from journal involves or shows which accounts are debited and which accounts are credited. For instance, in journal, if computer account and furniture accounts are debited with a total amount of rupees Y, and company ABZ Limited is credited with that amount, in ledger, the furniture account and computer account will be debited and accounts of ABZ will be credited by rupees Y. So that is what is posting of ledger accounts. Next, what we do is we see after posting is done, the accounts are to be balanced. So while balancing, if we find out that the difference in two sides are certain, it so happens that the debit side is greater than credit side, it becomes debit balance. And if it is vice versa, credit side becomes greater than debit side, it becomes credit balance. So balancing of accounts. The accounts that are to be balanced are those accounts of persons and properties first, and afterwards capital account is balanced. None of the other accounts are balanced since they'll be taken straight to profit and loss account. Now there are also rules for ledger accounts. The rules for personal account, there's rules for nominal account and rules for real account. Now we'll see what are those rules. So the rules for personal account is debit the receiver, credit the giver. Debit the receiver, the person who receives the cash, and credit the giver. Now for nominal accounts, it is debit all expenses and credit incomes and gains. That is for nominal accounts. And for real accounts, it is debit what may come in and credit what goes out. Now, so what are the different types of accounts? Personal accounts, which may be accounts of persons, creditors or customers. What is nominal account? Nominal account is income, expenses and losses. And what is real account? Real account are properties and assets. As I was explaining, personal account, the rule is debit the receiver and credit the giver. For nominal account, it is debit all expenses and credit income and gains. And for real account, it is debit what may come in and credit what goes out. Now, we are again talking about posting only. Okay. So process of recording transaction in a journal is called journalizing, and the process of recording transaction in the ledger is called posting. All transactions that are recorded in the journal are posted to ledger. Also, according to double entry system, any amount placed on the debit side of an account in ledger has a corresponding entry on the credit side of the same other account. Hence, debit balance should match with credit balance as a result of balancing of the account. Business usually arranges this in a statement, what we call it as trial balance, to check whether debit balance of accounts balances with credit balance. There are usually two methods of creating a trial balance. One is totals method, which is where totals in debit and credit balances of ledger accounts are balanced, excluding whatever is shown in the trial balance. So the totals of debit and credit balances of ledger accounts are taken and balanced. Trial balance, whatever is there, it won't be considered. As opposed to balances method. What is balances method? Where only closing balance of ledger accounts are as shown in the trial balance is only balanced. Okay. We'll also be discussing what is bank reconciliation statement, revenue expenditure and capital expenditure next. So this completes journal and ledger, posting and balancing. Okay. Now next is statements, expenses and expenditure. So before that, we'll first take a look at what is statements, bank reconciliation statement, which is a statement showing differences in balances between cash book and passbook. So in bank, there are two books. One is passbook, which is given to the customer, and then there is cash book. So we'll see if there is any difference between cash book and passbook. We do it in the bank reconciliation statement. Usually prepared by a businessman, it is normally a bank reconciliation statement prepared so that differences noted between cash book and passbook is reconciled as on a particular day. So on a particular day, bank reconciliation statement helps to note down the differences between cash book and passbook. Okay. Now let us now explain what is the difference between expenses and expenditure. Any short-term disbursal of money is termed as an expense and any long-term disbursal is termed as expenditure. Expenses are normally recurring or non-recurring in nature. To classify an expenditure as a revenue expenditure or capital expenditure, it depends a lot on the effects of earning capacity, nature of expense, as well as benefits incurred as a result of the expenditure. So now let us see what is revenue expenditure and what is capital expenditure. So as I was explaining, expenses incurred in the short-term period is actually expenses, and if it is long-term, it is expenditure. Now we'll see what is revenue expenditure and what is capital expenditure. Revenue expenditure or revenue expense is a recurring expenditure or recurring expense which is generated in the current year only. If due to an expenditure, revenue is earned in a short duration of time or the purpose of the expenditure is to earn income, that expenditure is also termed as revenue expenditure. So to rephrase it, revenue expenditure provides benefits in the current period. Some of the examples, so we can cite many examples, and some of the examples of revenue expenditure are purchase of machinery for sale. It may be daily wages of a peon. It may also be cost of replacement of a defective part of a machinery and expenses incurred in the manufacture of products. So that is revenue expenditure. Now what is capital expenditure? We actually know that capital expenditure is incurred. It's incurred in a longer term. So any long-term disbursal is actually capital expenditure. And it is also all non-recurring expense or expenditure which helps to generate revenue over a period of time slightly more than one accounting period. So the examples of capital expenditure is a petrol engine of a bus being replaced by a diesel engine, traveling expense for a trip abroad by a director for the purchase of machinery. So these are some of the examples of capital expenditure. So now we actually covered what is statements, expenses and expenditure. Thank you.